Now, I'm interested in your views and your thoughts on the recent questioning of the sector over the valuation of the private companies, comments about high fees, and whether private equity companies should buy back in their shares. And I'm going to start with Colin on this one.
We understand the concerns that people have about private equity valuations, but I think that there's good evidence that the valuations are well-founded. In particular, when I look at our portfolio, we have a long track record of making realizations at significant premia to the previous carrying values. There's a strong institutional framework in place. But I think also what's very powerful is that the alignment of the underlying managers is not to overstate valuations. They are not paid on unrealized valuations. Their incentives are always generated on cash returns. And that's one of the reasons why you see these significant premiums when things are realized. And I would also add that whilst obviously public markets have gone up and down in the last few years, that's been driven by valuation multiple changes, particularly in the tech sector. Typical private equity portfolios are much more diversified across multiple sectors. And in many cases, the performance within the other sectors has been much more stable. So I think it's my own view is that the industry has got a very solid framework for determining valuations. And as I say, we place a lot of faith in the cash returns.
Right, because it sounds to me like you think these concerns about valuations are overdone. Helen, have you got anything to add on valuations, or otherwise perhaps we can move on to fees?
Well, and again, this time it's Colin who's covered all the bases, so I'll just fill in around the edges. I would say that the valuation process is very robust at our managers. Most of them produce quarterly valuations. They're audited certainly at least once a year. And our own process, we have a monthly valuation committee meeting, and our valuations are also audited by our external auditor. So I think it's a bit of a myth that these valuations are sort of plucked out of the air. They do have a lot of basis, in the actual performance of the underlying portfolio companies. So that's on valuations. In terms of fees, I think it's important to note that when we talk about our performance, we talk about private equity performance, it is net of all fees. And sometimes I think that gets lost a little bit in the discussion. So the sort of fees that, the sort of performance we've been talking about, which is strong and has outpaced public markets over multiple periods and over the long term, is net of all those underlying fees. Now, private equity is an expensive asset class. We've talked about how there's so much value which is added to the portfolio companies. There's a huge amount of hands-on, operational expertise which is applied to these businesses over a long period of time, and therefore you do have a lot of people applied to working with the portfolio companies, and as a result, the fees at the underlying portfolio company are the standard sort of 2 and 20. However, I would say that I think people should look beyond this and look at the net returns that we're able to deliver.
That seems a very good point, to look at the net returns rather than getting too worried about fees. Richard, I'm conscious we haven't talked to you about valuations or fees yet. What's your thoughts on this?
Yeah, no, it's a good question. I mean, generally, if you look at the private equity segment over 5-10 years, medium to long term, it's been the strongest performer in terms of net return, which I'd agree with Helen is probably the most important thing to focus on. I guess if you look at valuations, as both Colm and Helen have said, there's very little incentive for private equity managers to overstate valuations, and there is a lot of effort that goes into overperforming and under-promising in terms of the valuations that are reported once an exit does take place. There doesn't want to be, it ought to be good news rather than a sense of disappointment when something gets sold. And so, a premium helps to deliver that. So, and as Helen says, I mean, what we do at Literacy is quite hard to do. We've got a team of 8 and we deploy relatively small amounts of capital. It's quite labor intensive. And so, it's not like buying a single listed stock where you do that over email or whatever platform you choose to do. I mean, it takes weeks or months of due diligence and tracking assets and investing and working with those assets. So, Yeah, it's a different ball game, but ultimately, if you look at the end results across the board for private equity are pretty strong.
Yeah, I think you're so right. All that due diligence, all that research before you buy, and then in a way, that's only the beginning. The work hasn't really begun then in terms of the people that you might bring into the business to work with it to improve returns for shareholders. Colin, the last issue was share buybacks. I'm wondering if you have any of these. A well-known analyst recently has stated that he thinks the sector should be buying back its shares more. What do you think?
Well, I think like many of these issues, there's no, you need a balance. So we view our buyback program, which was introduced this year in a more formal way. We've bought back in the past, but we now have a much more formalized program as being a really important part of our shareholder returns toolkit, if you like, alongside our dividends and also portfolio growth. So the balance has to be between making sure that you support demand for the stock. We obviously think it's a very good investment for the company, but also that we don't get in the way of people wanting to increase their allocation to listed private equity and in particular to ICG Enterprise. So we think we favour this balanced approach. We think that the shares are a good investment at any discount to NAV, and we've had good feedback since we introduced the programme, which looks set to continue.
Great, thank you. Helen, I know you've introduced share buybacks too. Have you got anything else to comment on this?
No, we've actually been doing share buybacks for a while, actually, not just in the current period. And very similar to what Con said, it's a balanced approach. We have to weigh out doing a buyback versus the investments we have in the pipeline. Clearly, this sort of a discount, it's very accretive to the trust. So that's why we've been buying back.